You're listening to the Creative Capital Podcast. You're dying to learn about how you can create wealth through real estate investing? Then you've come to the right place. Join in every week as we go over the ins and outs of real estate investing and learn how you too can become financially free. What's going on, everybody? This is Josh Ferrari, host of the Creative Capital Podcast, with none other than Casey Chohan today. And we talk pretty high level today about how the rich pay no and low taxes. What is the difference between having to pay capital gains taxes and doing a cost segregation study versus having your investment inside of a trust, and how going about your business and kind of revolving it around the common law of a trust will take you from 20 to 37% of capital gains and of having to pay property taxes year over year on the property to going to having to pay zero property taxes and having zero capital gain. It's phenomenal, and it's something that's not talked about and not discussed. I'm so excited and honored that we were able to get Casey on the show here to discuss with us how he is able to create these trusts and how we have to, what the parameters are that we have to live in throughout these and operate through so that we're able to take the max benefit of what these opportunities are and all the different facets and ways that there are to basically strategize and get around having to pay taxes and LLCs and syndications. And he talks kind of high level on the business aspect of things, entrepreneurship, and he gives a few examples. And then I try to dive in and give you guys real life real estate examples. He's a real estate investor himself. He does invest in real estate, but primarily he's a tax accountant, and he works with some really high level individuals on the tax side and even on the vertically integrated advisory side, telling, like, he gave one guy, we discussed in the show, he gave one guy advice that took him from 5 million a year to 10 million per month in like a 6-month time frame, just from vertically integrating one aspect of his business. Just absolutely phenomenal things. Casey's great. He's got a wealth of knowledge, quite literally, on all the different ways that there are to dive into taxes and to really like ease in and out and weave in and out all of these different facets of it. So without further ado, guys, we're going to jump right into the show. Hey, what's going on, Casey? It's great to have you out on the show.
Thank you so much for having me on. I'm excited to share some tips with you guys.
Yeah, I know we had connected on one of the social media platforms, and you had just mentioned that you have, and we'd scheduled a phone call, got on the phone, and you're like, yeah, there's wealthy people out there that pay like no taxes, or that can pay significantly less taxes per deal. Like not necessarily an overall view as far as like CPA goes, or getting a cost seg study or something that can accelerate depreciation. But you actually mentioned a strategy that people could pay less taxes on real estate as a whole. And I thought that was extremely fascinating. I thought you were fascinating. You've been on Forbes, all the stuff that you've done, the businesses that you've helped, like multi-billion dollars up to this point. It's incredible. So all the stuff that I now know about you, the listeners need to know about you. So those that don't really know who you are and what you do, tell us a little bit about yourself and then what got you interested in real estate.
Got it. Yeah, thank you for that intro. So I'm Casey Chohan. I am the founder of a company called Together CFO. And what we do is we take the trust and foundation structures that the ultra elite and wealthy families and politicians have created, and then we share them with successful entrepreneurs. And successful entrepreneurs that are making a couple of $1 million all the way up to hundreds of millions of dollars, they all need a good tax setup, because this is the stuff that nobody really teaches you in school. And even the professionals in the game, they only know the game at a statutory level, at a state level, depending on which state they're living in, or wherever they took their state exams, whether it's a CPA, whether it's a legal attorney, they do their bar exams. It's all at a statutory level. And that's not where the game's really won. That's where the game's played the majority of the time with most people. But when you look at the elite families and the billionaires of the world, they're all playing the game at a different level altogether. And that's what we're going to dig into today.
So that's very interesting. And it was very high level. So I want to dive into what that means and what exactly it is that you do as a company through Together CFO. So, I mean, what do you do for a living? And then how does that play in a role into, tax savings and real estate?
Good question. So what we do is it's like a hybrid of a legal firm and a CPA firm coming together. And the reason we've done that is we wanted to have a single point of contact for people to be able to, one, create these trust structures, which is more of a legal type angle. And then the second part of it is to operate within those structures, which is legal / accounting, and then filing of the taxes, which is all accounting, and then defense of that structure if needed, which is both accounting and legal. So there's a big overlap here. So what I've done is I've hired a team of amazing people that can cover the spectrum on legal contracts through legal common law, accounting law questions, and then actual CPAs that do the filings, and then defense as well. So we are the go-to place for the full creation, the strategy, and defense of these legal structures so that our clients can save time and money because they don't then have to worry about, hey, I need 3 different types of lawyers to be able to create these documents, or more often. And then I don't know a CPA that's got the experience in filing trust accounting principles, which is very different to the GAAP accounting principles that most people are used to. So every single level, the game is played differently, and there's different rules, both legally and different treatment of accounting as well throughout the different levels. So it's really important to know that you really need to know experts in each of these fields when you're operating within them.
So let me try to see if I understand what you're saying and then try to relate it to real estate investing. Yeah. So say a syndication. So you're doing this syndication, raising money from investors. And typically people create an LLC to actually buy the deal, and then the investors buy a piece of the LLC. So what you're saying, instead of creating an LLC, you're creating some form of a trust for people to buy into. And it's got all this legal back-end jargon that allows you to have these loopholes inside of where taxes come out, or am I like way off?
No, you're not far off, but we don't use the word loophole. Loopholes are lower level strategies that, which is fine, right? And just to put it into perspective, loopholes are good for 98% of people.
Okay.
And there's enough loopholes to get most people down to a livable amount of tax that they pay, right? So I'm not hating on loopholes here. I'm saying they are the go-to tool for the majority of people. And you can Google it. It'll come up with a list of 20 plus legitimate loopholes that are current right now. But obviously, get this checked by your lawyers and your accountants to make sure, because they change all the time. And they're often capped as well. So you just got to be careful when you're playing with loopholes. But what we do is create structures. And the difference being is once you've got a structure created, there's no limitations. You could put $1 million into it, or you could put $1 billion into it. The structure can deal with all amounts of money. To tie it back into the syndication, I wouldn't change the way you set that up. You have your special purpose vehicle or your syndication LLC. And then all I would change is saying that rather than you going in as an individual owning that LLC, it would be your trust that would do that for you.
Okay. Your own personal trust. So this isn't like a large, say, umbrella company or trust that you would set up for a bunch of things. This is literally just for your personal taxes.
So this is, yeah. So each one of the trusts, there wouldn't be per deal. Think of it for a family. It's all about the family and keeping generational wealth and growing the wealth of the family. So for you, as an example, if you were going into a syndication deal, you're throwing 100,000 in, I would say don't throw that in through your personal name or your business name. Put it into that syndicate through your trust. So your trust is the entity that owns that percentage ownership of that LLC.
And then doing it through the trust instead of doing it through, say, an LLC buying an LLC, because I know a lot of people just do it that way. They have an LLC as kind of their company corporation that they funnel things through. Doing the trust way, I mean, what's the benefit there? What do we really get out of that?
So the beauty about it is now if the trust owns that asset or a percentage of that LLC, everything that's going to get distributed into the trust, you then get the benefit of the taxes, the extra privacy laws when you get into that trust level. And then on the real estate side, zero capital gains as well.
Zero capital gains.
Correct. Yeah.
Now, this all sounds almost too good to be true. So tell me, Casey, are there any negatives to doing it through a trust?
Yeah, absolutely. And, things that sound too good to be true often are, as we know from life experience. So this isn't, hey, everything's amazing on the side of the trust, because if you can't operate these trusts correctly, you get taxed at 37%.
Whew.
So it's not just about, hey, I've got this amazing trust document that's been created for me, away I go. No, you've got to now play the game within those rules and parameters, right? So in the trust 1041 complex trust world, they have their whole different set of rules and principles that are acceptable in that world versus compared to regular 1040 world that most people live in. So you've got to be careful. There's two real parts to it. One is the creation of the trust documents. And then the second part is the tactics to operate within those documents to get the taxable income as low as legally possible.
So, okay. Now, having read your bio a little bit and kind of having chatted with you off screen here, I know a little bit more about you and your experience and what it is that you've done. And you mentioned that you have taken these smaller companies into now multi-billion-dollar companies. So, first of all, how does one even do that? And then, second of all, what are you providing for them that is like such a tremendous like multiplier?
So how we got into the game, it was quite crazy, really. It wasn't by design or anything like that. My background is in accounting and finance. I did 8+ years with a large company called Flowserve, which is a $4 billion company. It was a $3 billion company when I joined, and they just keep getting bigger. So 4 of those years were over in Europe, and then 4 were here in America. And then I left back in 2016 and started my own business, which is Together CFO. And initially, I was starting by helping CEOs and founders of startups or smaller companies just organize their numbers so they could make better business decisions. Quickly realized that that was very chaotic, to say the least. And then we started kind of increasing our lower limit. So we'd only then take on clients that were doing at least 3 or 4 million. And then there's one case study in particular, which kind of got us into tax. Was we had a client, he was doing around 5 million a year, just over 5 million. We took his business from 5 million a year to 10 million a month within the space of 6 months of working together.
What was that business? What was he doing?
So he was doing genetic testing by the end of it when we got him up to 10 million a month. But initially, what he was doing to get up to the 5 million was he was taking swabs of people in high street and doing precursor genetic testing. So he was doing all the hard work by getting the leads in, the paperwork filled out, and the pre-approvals done. And then on the back end, he was just sending all of that package off to a lab to get tested, and then the insurance get billed. And because the lab was doing all that back end work, they were making all the money, or not all of the money, the majority of the money. So when we came in, we assessed, we understood what was going on, we tracked the numbers, and it was so simple. And when you boil it all down, the main thing that we recommended was to buy your own lab that had all of the, obviously I'm very much oversimplifying this, but generally speaking, you increase the vertical. So we bought the next level down, which was the lab. And then from there, we were feeding ourselves with our own leads and then keeping all that profit on the back end as well.
Okay. I mean, that sounds amazing. And that sounds intriguing
that was on the CFO side, right? So what happened was with the business, we managed to blow it up. And now he was on a 10 million a month run rate. He's like, KC, thank you so much. But now I'm going to have this huge tax problem if we don't fix this. So then he put me to work in an area where I was not very comfortable with, but you want to always deliver for your clients, right? And go above and beyond. So we figured it out. So I reached out to my contacts back at Flowserve, the Treasury Department. These guys deal with billions of dollars. So they then have their own network of people, family offices. I was thankful enough to have some connections that ran family offices. And we put together a great team of people that were able to operate in this world of taxes at a high level, and then ultimately figured it all out. It's all written in the tax code. Everything I do, none of it is like what you call it, trademarked or copywritten or just us. No. There's nothing to do with that. It's all written in 80,000 pages of tax code. You can go figure it all out yourself. Be my guest. Go do that. Or you can work with someone who's been there and done that and got the t-shirt to prove it, right?
That's so awesome. So for the listeners out there, just to relate a lot of what he's saying specifically to real estate, it sounds like what you're saying is if you just get vertically integrated with your company, because he had this issue, really, I guess it wasn't necessarily an issue, but it was more of an opportunity, I guess, of, hey, you're sending all this stuff out to a different lab to do the work. Lab work has to get done regardless with the model you've created here. So why not we bring in the lab and then we make that money, and it just kind of, it feeds off of what the initial model was anyhow. So relating that to real estate, say you've got this flipping business and I don't know, you got all these contractors that you got to work with on a day-to-day basis, month basis, weekly basis. And instead of just continuing to hire out all these third-party contractors that are lazy or busy or got all these other things that they got to do, you just bring on your own construction company or contract company. Yeah. And then that would then feed off of that. And so you're saying that if we can just get vertically integrated with our business model, with our company, that will exponentialize our growth level there.
Yeah, to put it even simpler, you would go from being a flipper to a developer and a flipper at the same time, right? So you're sourcing your own deals, and rather than then filtering it out to someone else, you're keeping it all in-house. And then the next vertical would be real estate. So then you're finding it, building it, and selling it all yourself. And then you're keeping more of that pie every single time.
Yeah, I love that. All right, Casey, back to the tax specifics of it all and really paying no and low taxes. What really is the secret sauce to paying no and low taxes to Uncle Sam here? I mean, what exactly is the strategy? I mean, I know we've got the trust, but what do we need to do to continue along that path to be able to really,
So let me clear that up, because firstly, a lot of people don't really know what a trust is. And then when they start to dig into, hey, what does a trust actually do? They realize that there's a lot of different types of trust. And to be exact, there's 84 different types of trust and 24 different types of foundation. So it's very, very easy to get caught up in a charitable remainder trust or a REIT, or, there's a million, there's loads of them. There's way too many to go through every single one in the time that we have together. But just know that trusts can be broken down into a few general sections. The first one is the type of law that you want to apply to the trust. Now, 99% of trusts are statutory trusts. What does that mean? That means that they're created and operate within a state, and they're bound by the laws of that state. That in itself is the first failure. If you can get your trust based on common law principles, that is the one single thing that all of the ultra elite and the rich politician families and the controlling families, they all have in common, is that their trusts are not based on state laws. They're based on common law principles. Now, I highly advise everyone listening to go out and Google common law and get a better understanding of it, because it is the oldest law of the land, and it's based obviously on English law principles. And that, generally speaking, the way it translates is you can create a contract, and that contract is then upheld by the Supreme Court, which is the highest court of our land. And that then allows you to tap into these rules and regulations that have been already fought over in court, and a ruling has been made. So you're not doing anything new here. You're just following previous rulings. And that is really the key to unlocking how to operate at an elite trust level.
That's so powerful. The different levels of trust and common law. Like, I feel so uneducated right now. I haven't heard of any of this stuff, and I've been in the game now for 3 years. But I'm sure there's people out there that have been in the game for 30 years, 40 years, and have never done anything like this.
This isn't talked about very often because it is just a handful of people that know about this, and they keep it very close between themselves. And it's the two sets of people. One is the really wealthy, and the other is the politicians, because the wealthy can't get these laws passed without the politicians. As an example, let's just use Warren Buffett. So Warren Buffett's dad, Howard Buffett, he was a senator for, I think, Nebraska back in the days, right? He learned all this stuff from the inside. He set up the Buffett Family Foundation years ago, which was what Warren Buffett inherited and learned all about and lived his childhood through these trusts, knowing the inside game. He's obviously one of the most wealthy men in the world and has now set that foundation forward to his son, Howard Jr., and he's now taken over the foundation. And the key principle behind all this, once we get over the common law, which is super easy to figure that out, the next set of things is a phrase that Nelson Rockefeller quoted as, and it's taxation follows ownership. So you've got to give away all of the ownership of everything that you have, but retain control. So it's always a game of ownership versus control. If you don't own it, you don't get taxed on it. But if you control it, you're still in control of everything, but you don't get taxed on it.
I feel like this is very high level stuff here. So let's try to unpack some of those things. So explain the last thing you just mentioned with the control and ownership and how that could, like a real life example of, say, a real estate investment and what that might look like.
So really simple one. Let's use a house, right? So you're going to buy a house and the house is owned by a trust. So the deed of the house is put into trust, which is a really common thing that people do right now, right? They put it into trust for various reasons. The main one being that it's got an extra layer of privacy behind it. So if someone does a search on you, they can't see what that trust owns, right? And it's not in your name, so it doesn't come up on your record. So you don't have a target on your back or a bigger target on your back from people trying to get all your assets, right? So in order to do that, you have to give up ownership of that property and put it into trust. So you as an individual no longer own that property. The trust owns it. But if you are the trustee of that trust, you control everything that goes on in that trust. So although you're giving it away, and therefore the taxation is different in that new entity that's created, you are still in control of everything. It's like being the quarterback of an American football team.
Yeah. So is it similar to, say, besides the tax benefits and I'm sure a ton of other things, is it similar to an LLC in regards to, I know a lot of people create an LLC to buy real estate specifically for the legal protection of what you were saying, that something happens at their property, they get sued, someone's going after them, they can't take all of their assets if they have like one individual LLC for each deal or like a series LLC, umbrella corporation.
And you should use an LLC, right? I'm not knocking on LLCs here. All I'm saying is an LLC gives you limited liability, but a trust gives you privacy. It's two different things.
Okay. So explain what privacy means.
So let's just say that you own 10 homes and 10 different LLCs, right? Someone does a search on you, boom, all those LLCs come up with your name next to it and the assets that they own. All of a sudden, it's like, all right, Joshua owns a lot of property here. If we did go after him or find a way to sue him or, whatever, you've got a big target on your back now. If that same scenario, you control 10 homes, but they're owned by your trust, someone does a search on you, nothing comes up because they can't see what assets the trust owns.
Okay. Can't see anything that the trust owns.
Nothing. It's totally secretive.
So, man, I'm like taking all this in,
There's a lot to take in. It's a lot of information.
It is. And it's such high level stuff. I'm trying to figure out how to incorporate it on a floor level here, but
we'll get into it. We'll keep digging, and then we'll work the way into the tangible use of it. Because ultimately, high level is good for understanding, but we want to really get down to the nitty gritty of how people can apply this and ultimately make those tax savings rather than just talking about hypotheticals, right?
So let's just dive right into that. I mean, give us a real life example of how we could, like, what would be your advice to someone that's never done anything with a trust before, doesn't know anything about it, but is hearing what you're saying and is extremely interested in the tax savings and the privacy? What do they need to do?
Oh, firstly, reach out to me. Goes without saying, right? But yeah, you got to read up on it. You got to know a little bit about what you're getting into, right? So, common law principles. You want to read up on irrevocable trusts, non-grantor type trusts. There's a lot of reading to do, and I have all of the good stuff to read, so you can get it really quickly. But generally speaking, let's just assume that the trust is the way you want to go forward. You'd have to set this up for you and your family, and the beauty about this is that once you set it up once, it stays with your family for multi generations. It doesn't run out. So, as an example, with the Warren Buffett family, it started with his dad. He then ran it, and now his kids are running it, and then their kids will run it. So, once the structure's created, it doesn't expire. So, that's a great benefit for wealth preservation and then wealth transfer as well. Because if you pass away, God forbid, you're going to go into estate taxes, probate taxes, and pretty much like 40 to 50% of your wealth will be wiped out for no reason at all, other than you weren't well prepared for it. So, another reason of being a trust, whether it be my trust or any other trust, it doesn't really matter, is that you can set the trustees. Because if the trust owns the asset, changing the trustee is not a taxable event. It's not a change of ownership because the ownership stays with the trust. It's just a change of control. And you can auto set this up as a successor trustee upon death, where the next in line can take over that. But you've got to educate them in how the system works and stay within the legal parameters of the systems.
So I'm so glad you mentioned that. That was kind of the next thing I wanted to roll into. You mentioned that there's a difference in how should be operating in, say, an LLC or a limited liability, limited partnership versus the trust. And it's not just like set it and forget it. What are some of those parameters you need to be living inside in order to get the full benefits of this?
So, firstly, and probably the most important thing, is that it's not your money. You've got to remember when you're operating at a trust level, you are a trustee, you're a custodian of the beneficiary. So everything that you do as a trustee has to benefit the trust. So you've got to put a different hat on and say, I've got my trustee hat on now. Everything I do, i.e., real estate investing, has got to be a positive gain for the trust. Or if it's like a risky real estate, the intent has still got to be that we're developing this piece of land or we're building houses or whatever we're doing with it, that it's going to generate some ROI, and therefore the trust is going to make money or benefit in some way, shape, or form, right? You can't just take the money out the trust and go shopping on Rodeo Drive. That doesn't fly very well if you get audited, right? There's no way to defend that. So you have to make sure, first and foremost, that everything you do is within the best interests of the trust. And then the laws are different, right? The tax code is very different. Let's just use a house as an example, seeing as though we're talking about real estate. And I'll give you a house example in 3 different scenarios. So right now, let's say you own a home, and when you file your taxes here in California, you can take up to a $10,000 maximum deduction for your property tax. If that property is held by the trust, then all expenses to maintain that asset and that are spent on that asset are fully deductible. So, as an example, if your property tax is $20,000, you can deduct it all. If you add a pool to the house or any other renovations fixing the house up, they're all maintenance of an asset that's owned by the trust. So you are maintaining or adding value to the assets in the trust. In that case, it would be a full deduction as opposed to a restricted deduction. If that same house is fully paid off and now it's owned by the foundation, there is no property tax at all. So property tax becomes exempt because you're in an exempt tax situation. But there's a few caveats with there. That isn't across all of the states. It's most of the states and most cities, but you do have to get through a few additional hoops to get that approval. But it is there. It does happen. So that's the same piece of property in scenario 1 in the 1040 world, regular LLC, where you're capped at your deduction that you can take. In scenario 2, at the trust level, same house, but you can take all the deductions And in scenario 3, just a complete removal of property tax altogether. And yet it's the same asset we're talking about. 3 different types of laws, 3 different types of rules, right? And you can dictate which one of those rules you want to follow by setting up your trusts in the right way at the beginning.
That's so insane. The fact that that's even possible. So what about a scenario with a larger asset? Say you're in a syndication. I like to use this model maybe for a selfish reason, but also I know a lot of the listeners are interested in multifamily.
That's fine.
So with a syndication, you've got a lot of different hands in the pot. And so you being a general partner or a passive investor, you might only own 10% of the deal. So with your 10%, you've got a certain amount of taxes you got to pay and so on and so forth. So having everything funneled through the trust, say the 10% of property tax you have to pay on this multifamily asset, does that become completely tax-free at the time of there being no more debt on the asset, or what does that look like?
No, because the asset is owned by the LLC, I'm assuming, right?
Right.
So the asset isn't owned by your trust. So this only works for assets that you physically own in your own name, or sorry, not in your name, in the trust's name, right? So let's just use numbers as an example. Let's say you put 100K into a syndication. You're an accredited investor, you put 100K in. Now, the syndicate is going to do a lot of things in terms of cost segs or bonus depreciations. They're already smart enough to do a lot of that stuff so that you'll get some write-offs ahead of time, which is great. And that's perfectly fine. But if you're in 10, 20, hundreds of these deals, you need more than what's on offer, right? So in that case, anything that comes back, let's say you put 100 grand in and the return is 300K in 2 or 3 years' time, right? So now you're going to have a pretty significant capital gains tax to pay. It's going to be between 20 and 37%, give or take, depending on short, long, what state you're in, what federal, all the rest of that stuff. So let's just say on the low end, it's going to be 20%. On the high end, probably 37%. So now when that distribution comes, it doesn't come to you as an individual. It goes into the trust. So now that money is in the trust because the investment initially came out of that trust. And the rules and regulations at that trust level are completely different when it ascertains to capital gains. So when you research common law principles and you look into capital gains, you'll see that the tax code says that there's no capital gains at that level. And it's like, well, how can you not have capital gains? And how does nobody know about this previously? Well, it's all written there in the tax code. If anyone wants to go take a look at it, they can. It's just they don't know where to find all of this. And that's half of the problem, is that it's hidden in plain sight and it's very cryptic the way that it is kind of communicated to people, because the rich and the powerful and the elite, they don't want everyone to be able to go in and do what they're doing, right? That's the other part of why everybody doesn't know about this. When you look at the way lawyers are taught, they're not taught common law principles in their law schools. They're all taught statutory law based on whichever school or wherever they're operating in. Very, very few of them would go into really researching, hey, what is common law principles? How can I kind of learn about this? And ultimately, there's not going to be many opportunities for them to come straight out of law school and make some money as a lawyer if they're just focused on common law principles, right? Because nobody really knows about it. You need to know what you're going on about. And if you look at like the tax code in section 643, it's all there for people to read and go through. And that's where a lot of the good juice is hidden.
So earlier you mentioned if we bought this deal, or you mentioned that it was still a good idea to buy it through, say, an LLC. But what if we created a trust for a deal, and then the deal ran the standard life cycle of like standard syndications of 5 to 10 years, and then we had all the investors invest inside of the trust? I mean, what would the tax savings on that look like? What would the cost to put together that trust look like? Would it even make sense?
The trust, no, it wouldn't make sense probably for a syndication. I still think the LLC is the easier way to do it, but the ownership, so the multi-members of the LLC can all be trusts.
Okay, so they can have their own individual trust, but we'll still have an LLC for the asset.
I think that's the better or the cleaner way to do it when you're looking at syndications, yeah.
Okay. And they'll still get all the benefits because it's their trust, even though the trust is invested inside of an LLC.
It's an investment from the trust's perspective. We put our trust hat on now. So what we're saying is, hey, we've got $100,000 in cash. We're going to invest it in Syndicate A. It's going to return us 300K. Okay, well, we don't have to pay any capital gains on that investment.
Okay. Now, here's kind of an off the wall question, and I don't know if it pertains or if I'm just ignorant, but what if you're filing as a real estate professional and you've got everything going through this trust? Does that have any effect? Does it matter? Like, what does that look like?
No, it's a good question. And for the people who aren't real estate professionals, they really should use that. That's a really good strategy kind of before you get into needing a structure because it's a really good write-off. So the way it works is the same. The structure is still the same. And the money that you make is owned by the LLC, right? So let's just say that you're a real estate professional and you've got your real estate business. It's an LLC and you're doing your deals. We would just change the ownership of that LLC so that the trust would become the majority owner, and therefore we would distribute more money in via a K1 at the end of a year or a period into the trust, and therefore get the benefits of the trust. And then you personally would get the benefits of being a real estate investor as well. Because that's the real estate investor is just at a personal level. What you got to remember is when you're setting up these trusts, they are their own individuals, so to speak.
Okay. Man, we could talk about this for hours. I got so many more questions, 80,000 words and pages on freaking tax code. That's insanity. But for the sake of time, I got one more question to ask you before we jump into the next segment here. What is, I know you don't like the word loophole, so I'll use the word like strategy. What's a massive tax strategy for entrepreneurs specifically that we haven't already discussed that you use and know to be extremely helpful?
Well, I use the trust. So that's the only really thing that I need to optimize my taxes personally. But another thing that most people could use, and this is not just real estate people, this is everyone, is what they call an IBC policy. It's life insurance, it's whole life insurance. The difference with the IBC policy is you become your own bank. So think of it as you're creating your own bank and therefore get the terms and conditions of how your money is being used. And therefore you can create wealth. And just to simply put it, you can put money into this and then earn dividends on all of the money. You can take money out and still earn dividends on all of the money and then still reuse that money that you've taken out. So you effectively get to double dip on your money. And that's a really advanced strategy that we share with our clients after we've set up their trusts, because again, similar to the house scenario that we talked about, if you do this in a 1040 world, you're restricted on how much you can put in and the full benefits of it. If you do it in the trust world, which has different rules and regulations, you can really push this policy or this kind of illustration to the next level.
Well, dang, now I have another question.
So, keep going. Let's go.
So with that life insurance policy, do you actually have to dump money into the policy before you can take anything out? Or is it like a standard life insurance policy where, say, you get $1 million of coverage and you can just borrow this $1 million that you never even really had?
It's a hybrid of what you just said. So you have to put money in. So there's a base premium that you put in every single year. And then that gets covered by insurance on a life. Let's just say myself. And what happens is they put a value on your life. So let's just say my life is worth $20 million, right? So when I die, God forbid, it's guaranteed that we're going to die, right?
Right.
So they can say with certainty, you will die. And when you die, your beneficiary of this policy will receive $20 million. Now, one of the other clauses in these contracts are that you can borrow against that $20 million. You can borrow up to the amount that you've put in on the policy side. So there's two different vehicles here. One, where you're putting money in. So let's just say you put $1 million in. You can take out up to 90% of that, but still earn the full dividends on all $1 million.
Wow. So how do the dividends work? I mean, what kind of returns are we talking over, say, an annual basis?
It gets even better. So Mass Mutual is the company that I use, right? Full disclosure, I don't get any money for that. But so I use Mass Mutual, and they give me a guarantee in my documents. It's like this thick, my document pack, right? I get a guaranteed 4%, regardless of COVID, no COVID, the world's coming to an apocalypse. And then plus I get the dividends that vary year on year. So as an example, last year I got 6% from Mass Mutual on my policies, and I've used 90% of that money in my real estate deals.
Wow. So I need to be looking at this. Everyone needs to be looking into, what did you say it was called again?
It's called IBC, Infinite Banking Concept. And there's a book out there by a guy called Nelson Nash that you can just Google or put him into Amazon and buy his book. He kind of founded this structure, policy, whatever you want to call it. And then the top companies in the world, Mass Mutual, I think there's like 5 or 6 other mutual companies that hold this policy. Not everybody does it. It's very niche and very specific. And that's what I personally use and what I encourage my clients to use, because you get to double use your money. It's working for you, building wealth, and then you get to take it out and then go reinvest it somewhere. Yeah. And Tony Robbins talks about this in his book, Money, Master the Game. In chapter 5, he talks about, he doesn't call it infinite banking concept, but he talks about how to invest your money and take it out and get really good returns.
Whew. There is some really good stuff there. And I have some reading up to do after this show to really educate myself on what might be good for me, as do the listeners. So, okay, we're going to go ahead and jump now into the next segment of the show, which is a little comic relief here, called our Pod Decks segment. And I don't know if you ever heard of Pod Decks, but it's a company that just makes decks of cards, and they just have questions on the back of them. So this is like completely random. We're just going to shuffle through this deck here. You're going to tell me when to stop. We're going to pick 2 cards, and then we're going to ask whatever the heck the card says.
All right.
So tell me when to stop.
Stop. Stop.
All right. You ready?
Yes, sir.
Ready for your questions. All right. First question. If you could change anything about the way you were raised, what would it be?
I would have more time with my dad. He was working a lot all the time, traveling, hustling, and he missed out on a lot of family time because of that. But I get it. You know, when you're a provider, you've got to do what it takes to put food on the table. So he was always traveling a lot. So I missed a lot of time with him. So I would change that.
So are you a father now yourself?
Not yet, but we're trying. So fingers crossed soon.
Yeah, soon. Then you could be that dad that you always wished you had.
Absolutely. Yeah. I'm going to be at soccer practices, screaming from the side and, you know, all the rest of that stuff.
I too look forward to that. All right. Next question. What is one subscription you just can't live without?
Oh, that's simple. Zapier.
What does Zapier do for you?
My goodness, it's the glue behind all of these other subscriptions that don't speak to each other. So it literally takes everything that I do and shoots it into my CRM, which kind of is the hub of everything that we do, who we're talking to, what deals we're doing, keeping our clients up to date. And kind of without that, being able to speak to 10 different softwares and bringing everything into one place, I would be in trouble. I'd need a lot more manpower to kind of run the show.
Yeah. I love that. I actually recently started integrating Active Campaign and Zaps and Zapier.
Yeah, we use Active Campaign, so it's a super powerful tool. But if you can't get the data in there efficiently and instantly, it's a problem, right?
Definitely a problem. Well, cool. I'm sure people got something out of that too. What was supposed to be comic relief. Look at that. You spitting out knowledge bombs here. All right.
I love that software. If I owned a part of that company, I'd be a happy guy.
Going into now the last segment of the show called the Core 4, same 4 questions we ask every guest. First question, what is your favorite real estate related book?
It's got to be one of the first ones that I read, and it's Multifamily Millions by David Lindelof. It's up there on my shelf somewhere.
Yeah, I read that book. It wasn't the first one I read, but when I really thought about getting into multifamily, I'd heard someone mention it and read it, and it was a powerful book. I really enjoyed it.
He has 2 good ones. He had that one and the other one on emerging markets. And they're both pretty good, but I like the Multifamily Millions one a little better.
Love it. All right, next question. What do you think your unique skill is that helps you become successful?
Never give up.
Never give up.
You only lose when you stop.
Definitely true. All right, Next question. Tell me something that's true about real estate that almost nobody agrees with you on.
The tax stuff that we just talked about for so long. Nobody knows it, so they don't understand it. So they're instantly kind of skeptical until they do a little bit of digging and a little bit of research. And then they're like, oh, holy cow, that this is crazy. How have I not known about this? And, the problem a lot of the time is that the advisors around all of us don't know either. So if they don't know and they're the go-to people, they're not going to advise you on something that they don't know about. And it's often not in their best interests to advise you to go to it because that means they lose you as a client too. So one of the biggest obstacles that we face is that, hey, we'll have a conversation with someone. They're like, okay, let me check this out with my accountant. I'm like, well, might not be the best person to check with. Like, oh, well, why not? I've been with him 20 years. He's my guy. I'm like, yeah, but he's not going to want to lose you as a client. And if you do this, it means he loses out on a client. You're better off going to a lawyer that's well versed in common law principles and estate planning, who is also a CPA. And there are people out there that exist that are both legal, estate planning, common law lawyers, and CPA qualified too. And it just so happens that one of those lawyers wrote us an opinion letter on the legality of our trust and everything, just to kind of give that extra comfort level. But it's tough because there's not many people out there that can scrutinize these types of documents or even talk to common law principles and then advanced strategies and then advanced taxation all at the same time. So you have to upgrade your advisors, really.
Yeah, you got to know the billionaires of the world.
Pretty much, yeah.
Got to be in the room with the right people. You are who you surround yourself with, right? Is that the saying?
Yeah, you are the average of the 5 people you spend most time with.
Isn't that crazy? Like if you really just sit back and think, who are my 5 closest people that I hang out with? Friends, my spouse. Like where are they at in life? Financially, spiritually, mentally. And then that's where you're headed.
Yeah, absolutely.
It's so scary. True, yeah, it's scary sometimes if you're not surrounded by the right people. Like, man, I don't want to be stuck in a day job.
And then the other one is you can't be the smartest guy in the room. Like if you're the smartest guy in the room or gal in the room, you're definitely in the wrong room. You need to get out and find a new room.
Well, at some point, I feel like there's always going to be someone in a room that's the smartest in it. And maybe there's always going to be someone smarter, which I'm sure there will be. But at some point, I feel like there's a peak where it's like, okay, I'm a billionaire.
No, you're in the wrong room because even if you're a billionaire, you can always learn, right? And I'm always learning and always curious and pushing myself in different directions. Now, when it comes to tax, I can talk till the cows come home in the morning, right? But when we're talking about taking a rocket to Mars or I don't know the first thing about that. So I'm like a novice in that area. So it's not necessarily IQ level. It's more about being more of a well-rounded person. And yes, you are a specialist in what you do, and so you should be. And if you aren't, get to the top 1% of your industry first or close to. But along the way, don't just be single-faceted, be multifaceted. Learn a few different things. Surround yourself with different types of people that'll push you and make you grow in different ways.
I love that. 100% agree. Okay. What one piece of advice would you give to our listeners wanting to succeed in real estate investing?
Educate yourself. You can't rely on other people to spoon feed you. You've got to go find these things out. We live in such an amazing age where literally on your phone, you've got all this power and knowledge to be able to research and learn things. The worst thing you could do is kind of put that off or put it onto other people to do. Yes, build a team of advisors around you. You can't get to being a successful entrepreneur without a team. So you need that. But you also have to have the knowledge, or at least a base knowledge, to be able to talk the talk, learn the language, know the terms. And if you don't, then there's so many free courses out there. There's YouTube, there's Google. You could acquire a lot of knowledge for free, and there's no real excuse for that. So you either have the desire to do it, or you're just talking the talk and trying to kid yourself.
Yeah, definitely. Okay.
Bit of tough love at the end there.
Yeah, and it is. A lot of times it is tough love. And if you don't just take action, then you're never really going to get where you want to be. If you actually want to be an entrepreneur, you want to get out of your W-2 job, you want to eventually become a millionaire or a billionaire, or just not even that, just financially free, just enough money to get out of the grind of that daily life. But you're not going out and educating, you're not meeting people, you're not making phone calls, you're not doing all these things, then you haven't changed anything. You haven't changed your lifestyle. So you're going to continue to get the same results. In the phrase, like, it's considered insanity to continue to do this. Like, definition of insanity is to do the same thing over and over again and expect different results.
Correct. Yeah, that's exactly right. And to touch on your point of passive cash flow and kind of financial freedom, you don't have to like aim for hundreds of millions here. You just need to know your numbers. So the simplest thing you could start off with is knowing what your number is. Like when I first kind of read Rich Dad Poor Dad and Cash Flow Quadrant and kind of improved my own mindset, it's like step one, how much do I need passive cash every single month to live? What's my number? And that's different for everyone, depending on what your lifestyle's like, where you live, like what you want, whether that's $1,000 or whether that's 20 grand a month, it doesn't matter. The thing that's more important is that you write it down. You know what your number is, where your target is, because if you're throwing a dart at a dartboard and you don't know where the target is, then you're just throwing darts aimlessly. You have to be aiming somewhere in order to hit that bullseye. So know where you're going and you can plan accordingly from that point on.
Love it. Casey, if anybody wants to learn more about you and your business, how can people get in touch with you?
The best place to go would be the website, which is togethercfo.com. Or you could hit me up on all social media platforms. It's going to be Together CFO, or my name is KC Chohan, just spelled the two letters KC and then CHOHAN. And yeah, that's probably the best two ways.
Love it. Well, I'm definitely going to be doing some research after this. I feel like my brain it just exploded with the amount of knowledge that it now has. I'm excited, and I'm sure the listeners are too. I'm sure they learned a ton from this. So they might be reaching out to you. I know I will, and really appreciate you taking the time to come out on the show with us.
No problem at all. You're welcome. And hopefully we've added some value to you and the listeners.
Absolutely. All right, man. See you later. What a fantastic show. I'm so stoked that you guys were able to listen today to KC. And if you guys know anyone kind of in the threshold of paying about $200,000 in taxes and up to maybe about the family office REIT space, then that's kind of his avatar, his niche of individual that he's looking for to work with on the accounting side. So feel free to reach out to him. Phenomenal dude. As you can see, he has a wealth of knowledge to give out. So guys, that's pretty much all we have. If there's anyone out there listening to the show that runs a podcast currently, or is doing all of their own editing or marketing, go check out Adam Adams and his podcast stuff. That's who I use for all of my back-end podcast editing and marketing. And he does a fantastic job, as you guys can tell from the episodes that are released here. We've got a YouTube channel. He does video. He does audio. Go check him out. He's a great dude. So to wrap things up here, guys, please leave a rating and review for the show. It helps tremendously with new listeners coming in to learn more about real estate investing, learn more of the different creative strategies that there are to create wealth. I'm so dumbfounded. Every time I do a show, there's a new creative strategy. Like, who would have thought you could just create a trust and pay no taxes for life, or pay little to none, or have no capital gains on your real estate purchases, or invest in a syndication through your trust and get the benefits of the cost segregation and paying no taxes on it. There's so many different strategies out there, guys, and we are here to try and help you navigate through all of the different facets and options that there are out there. So if you guys could leave a rating, it helps you, it helps us, and it helps others continue to learn and be exposed to these types of opportunities. And then lastly, I think this episode will probably be releasing sometime in April, probably mid-April. And if you guys haven't already, we've probably begun diving into or are already doing. This is kind of like a sneak peek if we're not doing it already. A money raising challenge for anyone out there interested in actually learning the ins and outs of raising capital and what that might look like. So for anyone interested in that, I don't really have anywhere like a website specific for you to go to right now. But what you can do is you can schedule a call with us. You can reach out to us. You can go to ferraricapital.com and fill out the talk to us link or schedule a call with me and let me know that you're interested, or find us on social media at Ferrari Capital on Instagram or Josh Ferrari on LinkedIn or Facebook. And let me know that you're interested in learning more about how we were able to raise. At this point, I think I've raised over $7 or $8 million, and $6 million of that was in a 30-day time frame. So learn how we did that, how you can do that. And like, if you were able to raise even just a few $100,000 in that 30-day time frame, how significant would that impact your real estate business? How much more would you be able to move forward with that? So feel free to check that out and feel free to reach out to us about that. Now, that's all I got, guys. This is Josh Ferrari signing off.